Amateur investors dream of spotting a stock, buying at rock bottom, and cashing out at the peak. Gurus promise formulas for these turning points. In reality, the market moves with a jagged, unpredictable energy that defies simple patterns. If perfectly timing the market were actually possible, the people with infinite resources and data would do it every time. They don't. Take the case of Vijay Kedia, one of India's most successful investors. Years ago, he made a massive move into Tejas Networks, investing roughly 100 crore rupees. Almost as soon as he bought in, the stock price shattered. It plummeted 90%, vaporizing 90 crore rupees in a matter of months. This crash represented the near total destruction of his investment. He had bought in at what looked like the absolute worst moment in the company's history. Yet despite that catastrophic entry point, Kedia stayed the course. By the time he eventually sold that position, he walked away with over 900% in total returns. If the most elite investors routinely buy at the wrong time and still win, the amateur's obsession with the perfect bottom price is a dangerous distraction from what actually builds wealth. The very structure of the financial industry admits that market bottoms are unpredictable. This is why systematic investment plans, or SIPs, are the standard for mutual funds. If experts could pinpoint the bottom, SIPs wouldn't exist. Instead of dripping money in small, rhythmic amounts, everyone would dump their entire capital in at the lowest cent. The industry uses SIPs because no one knows when that gap appears. Even Rakesh Jhunjhunwala, a titan of the Indian markets, faced this exact uncertainty when he moved into Federal Bank. This chart shows the sudden vertical collapse of the market on March 16, 2020. Jhunjhunwala had purchased his shares shortly before this global pandemic triggered a violent, indiscriminate crash. Since these extreme movements are impossible to forecast, these billionaires must rely on a metric that has nothing to do with the price on the screen. These investors survive crashes by valuing the physical infrastructure and revenue streams of the business itself. They prioritize the real-world utility of warehouses, logistics, and inventory, assets that remain stable even when the stock price swings. When a stock price falls, amateur investors fixate on the visual discount, wondering if they should buy more just because the number is lower. Professionals use a different filter. They look at the drop and determine if the cause is internal to the company or external to the market. An internal drop means the core business is failing due to poor management decisions, products failing to sell, or the company facing a legal investigation. If the business itself is broken, the instruction is simple: get out. A mathematically cheap price won't save you if the company is heading towards insolvency. An external drop looks like this: a sea of red across the entire market. Panic over global tensions or a pandemic drags every stock down, even if the underlying business is operating at peak efficiency. These unjustified market-wide panics are the only times you should average down. You are buying more equity in a strong company while the rest of the world is selling out of fear. A falling price is just noise. Only the root reason for that fall tells you if you are looking at a financial trap or a generational buying opportunity. This leads to the opposite problem. What do you do when a stock you love is climbing rapidly, but you want to own more of it? Rushing to buy during a vertical rally out of a fear of missing out is usually a mistake. It forces you to pay a premium that dilutes your long-term return percentage. Looking at the history of the BSE reveals a recurring pattern. Economic cycles reliably trigger a market-wide dip every few years, pausing even the most aggressive bull runs. During these periods of extreme optimism, the best move is to hoard your capital and wait. You are waiting for moments like this: unpredictable geopolitical shifts or global policy changes. These events create the temporary, artificial price drops you need to buy back into your healthier businesses. Buying a failing business at the absolute perfect bottom will lead to bankruptcy, but buying a phenomenal business at the absolute worst time will eventually be redeemed by its growth. Stop timing the price and start validating the business.